Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Will Rhind, CEO at GraniteShares. We're talking about rising inflation today and how investors can protect their portfolios in this environment. And GraniteShares offers 3 commodity ETFs. So we'll take a look at those 3 ETFs too, and whether commodity ETFs can protect investors and provide a hedge against rising inflation. Will, welcome. Thanks so much for joining us.
Thank you, Nina. Thank you so much for having me again. Pleasure to be here.
So recent inflation reports have been much hotter than expected. The CPI report, which was released on Friday, that showed prices rising at the fastest pace in almost 40 years. And the PPI report, that was also very hot. PPI index jumped 9.6% in November, which was its quickest pace on record going back to 2010. So I wanted to start with your thoughts on this recent inflation data and whether investors should worry about inflation now.
So this has definitely been a year where those that were fearful of higher inflation in the economy have been vindicated, and we've seen higher prices for it seems like, and it feels like, almost everything across the board, and whether that's domestic appliances, which has risen by 7.1% this year, whether it's proteins across the board over 10%, whether it's coffee up nearly 100%, or even rental cars up by over 42%. So it feels like prices are rising across the board, and certainly this is by far and away the topic of the moment in the investing world. And, I think that like some periods we've seen before in history, this will prove to be quite similar, whereby these inflationary pressures that we're seeing are more persistent than perhaps certainly the Federal Reserve thought initially, but a lot of people thought, I think, initially.
So you mentioned used car prices too. So earlier this year, we saw that these rising prices were confined to these categories like used autos, electronics, furniture items, because these categories were witnessing global supply chain disruptions due to the pandemic. And many experts said that these price pressures would moderate because supply chain operations would normalize, and also stimulus-fueled consumer demand would ease once that stimulus fades. But lately, we have seen these inflationary pressures have actually spread to newer areas too. For example, we have seen housing costs go up, and you are in Manhattan, and you must have seen rentals in Manhattan have spiked. And housing accounts for a significant proportion in CPI. And consumer demand, on the other hand, has not moderated at all, and that is probably due to we have seen improvement in labor markets and wages have been rising. So, do you think this inflation is going to persist in 2022?
Yes, I do, and I think that I understand the narrative around a lot of these pressures being short term, but I think the longer that they go on, the less short term they become. And, I think just one factor that by no means explains, the reason why consumers seem to be more robust. But I do think that, on the one hand, prices are going up left, right, and center, but, a lot of people are still working from home. And so there's a lot of cost that people are saving through the different lifestyles or lifestyle changes that they've adopted now through COVID. I mean, for the most part, people are still not really traveling in the same way that they did before. So that means taking vacations, socializing in the same way for a lot of the country. And so people just aren't sort of spending money in the way that they did before, perhaps the same level. Now, that all being said, I do think that the core of this problem is that inflation is always a monetary phenomenon, and put very simply, we have too much money, chasing too little goods and services, and that to me really is just the crux of what we're talking about today.
So how can investors protect their portfolios against rising inflation? We know that unprofitable companies with very lofty growth expectations, these companies which would produce some profits in 2040 or 2050 or beyond, they should be avoided. Value stocks probably could perform better than growth stocks in rising inflationary environment. Then commodity stocks and commodities in general have provided some protection against inflation historically, but commodities are very volatile too, that investors should remember. Then some investors look at gold as a probable inflation hedge. So in your view, which is the best inflation hedge, whether investors should look at tips or value stocks or gold or other commodities? And if we look at commodities in particular, which commodities have provided most effective hedges against inflation historically?
Well, I think it's probably safe to say that there's no silver bullet here, in terms of there's not one thing I think that either I would suggest people do, or I think people should do. I think it's a combination of factors. So if we're talking about stocks, then the natural place to be is going to be companies that are able to either absorb inflationary pressures, and that's most likely going to be from those that can pass on those inflationary pressures to customers. So that's going to be companies that have pricing power in whatever particular sector that they're in, and those companies that are able to do that, that are able to withstand those pressures, will, all things being equal, most likely have a business model that's robust enough to do well even in a higher inflationary environment. I think, like you say, companies that are much more speculative, and the good poster child for this is on the technology side. Companies that very much their valuation is driven on very, very low interest rates or no interest rates. I think that those companies, the valuations will be challenged. But outside of stocks, tips would be a place that people have historically gone to for inflation protection. The trouble with tips and with bonds just more broadly is that the bond price is so high because one factor, interest rates are so low, but also people searching for either some kind of yield on the one hand or some kind of inflation protection, have bid those prices up quite considerably. So I still think if you take a step back, I think that areas like commodities and let's just say real assets more broadly is still an area that despite price increases that we've seen, still perhaps represents some value in a portfolio, plus have some direct benefit to a portfolio. So in the direct commodities world, yes, the commodity prices can be volatile, but if you think about what's causing a lot of the inflationary pressures, it's the rising energy costs, it's rising food and materials costs, and those are all direct as a direct result of commodity prices rising themselves. So if you take a broad commodity index like the Bloomberg Commodity Index, we offer an ETF linked to that. COMB is the ticker code, but you'll have a mix of energy in there: oil, gas, other energy products, agricultural commodities, and materials. And when you put those three together, I do think that you have a recipe that covers a lot of the primary inputs that are contributing to this inflation problem at the moment.
So you mentioned oil, and oil is one of the best performing commodities this year. It has come down significantly since mid-October, but it's still up about 40% year to date. And earlier this week, I saw that the OPEC released its monthly report and left its global oil demand and supply forecast for 2021 and 2022 unchanged. They said that Omicron variant is expected to be rather mild and short-lived. And we saw this insane surge in natural gas prices earlier this year. Natural gas prices had almost doubled, and particularly in Europe, we had seen this insane surge in natural gas prices. Natural gas prices have also come down since mid-October, and that is mainly on expectations of warmer weather, warmer winter this year. So could you talk a little bit of what is going on with oil and natural gas prices, and where do you see oil and natural gas prices in 2022?
Yeah, I mean, I think you just sort of outlined or summarized that really well. And I think that with both of those markets, despite the fact that prices have come down more recently, I think that really we're looking at a situation where, absent some of the specific European gas situations, we're looking at a situation where I think we see higher oil prices next year. But the vulnerability to oil and to gas really has come in the face of demand destruction. And that demand destruction from fears over the new Omicron variant. And as you've said, what's been interesting about this whole story is that the consumer is not backing down when it comes to purchasing goods and services. And so from that perspective, the consumer seems to be willing to pay the higher gas prices, willing to pay the higher grocery store prices, furniture prices, etc. But what happened specifically in the energy market is it has been a victim, at least short term, to lower demand expectations on the back of the new variant. And that's because governments have been rushing out to put in new restrictions. Some countries, again, on travel, either completely or partially, mask mandates, booster drives, etc. And all of that has made some fear that people will start to, slow travel, or at least, maybe cancel travel that they had in place. But the demand for oil and to a lesser extent for natural gas will decrease as a result. But I think that's really the only thing, and prior to this, what do we say? It's very difficult to see, how, absent of some demand destruction, how prices really would materially move lower. Because as you remember, it wasn't so long ago that the US administration, in coordination with some other governments around the world, did a coordinated strategic petroleum reserve release. And that was really designed to put more barrels, put more supply onto the market in order to lower prices, and particularly, obviously, gasoline prices at the pump. And I think that was, in a way that the prices did go down, but it wasn't necessarily as a result so much of the SPR releases. It was much more about the fears of the new variant and that creating some demand destruction. So I think if OPEC are right, and if Omicron variant turns out to be less severe than people expect, and we sort of resume that pathway to a full reopening. Remember that countries like China, for example, around the world are, for all intents and purposes, still closed. And we got to an $80 oil price in that environment where we still had a world that was definitely not fully open just a couple of months back. So I think if we're talking about a world that's fully open and that people are traveling, that the global economy, trade is moving as it was, let's say in 2019, I think we could be talking about a much higher oil price in 2022 than we are now.
Very interesting. Now, as you mentioned earlier, oil and natural gas, the energy is a major contributor to inflation. It gets a lot of allocation in the CPI index. So when oil prices go up and natural gas prices go up, inflation obviously goes up. And as these oil prices have risen this year, we have seen a lot of inflows into oil and natural gas funds, to particularly ETFs. So, do you think inflation is driving oil prices, or are oil prices driving inflation? Because this is a cycle, this is something which can feed on itself.
Yeah, you're absolutely right. It's a great question. I think, almost without hesitation right now, it's oil, gas, commodity prices that are causing inflation. And we are nowhere near the point where investors are kind of driving this market in any kind of meaningful way. Now we can talk about that with gold, and certainly perhaps vis-a-vis the 1970s in a minute. But I think as of right now, you've got to remember that the context to all of this is that up until I think incredibly recently, I'm talking about maybe even in the last few days, that the market has by and large bought the narrative from the Federal Reserve that inflation is not a problem. And inflation is just a transitory thing that is as a result of COVID or the global economy kind of opening up. And that these are all short-term things which will dissipate quite quickly. And so from that perspective, I don't think people are as worried about inflation as perhaps they should be. And indeed, when you look at positioning, yes, of course, there have been allocations into funds, into commodity funds, but there have also been huge allocations into bond funds, fixed income funds, in an environment where almost certainly you'd have to believe that interest rates are going to rise. Indeed, the Fed, if you count tapering as official tightening, it's already started. And so I think we're nowhere near the point where we have sort of mass hysteria around inflation and people running for the exits, looking to get exposure to any inflation hedging instruments that you can get their hands on. I think right now we still have the smart money in air quotes looking to start positioning or looking for positioning in inflation hedging assets. But I think by and large, people are still kind of buying this narrative that inflation is not an issue.
Right. So you mentioned gold as well, and I wanted to talk about gold because gold is usually seen, many believe that it is a hedge against inflation. But gold has underperformed this year. It is down for the year despite rising inflation. And this would be gold's first annual loss in about 3 years. So why has gold underperformed? Is it because of, many investors, particularly younger investors, millennials, they believe that cryptocurrencies, Bitcoin, they are the new digital gold, the new safe haven, or it is because of declining monetary support from central banks, or what is the reason why gold has underperformed this year? And do you think that gold can rebound in 2022 if inflation goes up?
So I guess to answer that is more of a technical point, I suppose. But the answer to your question is that it's a little bit of an anomaly because gold obviously was coming down off the back of an all-time high last year that it reached in August. So if you look at the chart and you bought on January 1, then yes, gold prices were still falling from last year. So you have, as the time here, you are underwater. But if you bought even just a few days later, you're flat to making money in gold this year. But that being said, I think your point still holds that gold hasn't been a superstar performer this year in an environment where we've had the highest inflation numbers for 40 years. And a lot of people are starting to ask or asking the question, well, shouldn't gold be a lot higher because inflation's higher? And I think there are sort of two sort of primary responses I have to that. The first one is that what's happening in the gold market is we're transitioning from the demand for gold that we saw last year, which propelled gold to an all-time high, was very much on the back of gold being seen or used as a crisis hedge. And so that was an environment where we shut down our economy, completely unprecedented. Nobody knew what came next in the midst of a global pandemic. And so we're looking for the highest quality assets with least counterparty and or credit risk. And so gold was bid up to an all-time high. As the vaccine announcements and all the other things we know about now came into effect, the need for gold as a crisis hedge dissipated. And hence, people sold gold or reduced positions and got much more aggressive on risk again as markets headed up. I think what that did was really create this environment where gold is transitioning from gold as a crisis hedge to gold as an inflation hedge. And it's actually interesting because if you look back at the 1970s, which was the period where gold prices really, when they started to rise in late 1976, peaking in January 1980, and gold prices increased over 8 times in that period. So they went very quickly, from $100 an ounce in late 1996 to $850 an ounce in January 1980. And if you look at the 70s just as a period and you study that, and what's kind of interesting to me is that just like now, gold prices actually, after the initial peak or the initial bump, I should say, when the US went off the gold standard in the very early 70s, the gold price was actually sort of trending down for a number of years. And it was really, like I said, it really turned in the fall of 1976. And you were in an environment where in 76 and in years before, the US economy had high inflation, numbers sort of not too similar to where we are today, perhaps even a bit less. So you had a high inflationary environment, you had unemployment was higher than it was today, and you had a central bank or monetary policy that was using sort of might call modern money printing techniques to try and stave off unemployment. But as we now know, it was sort of exacerbating the inflation situation. But I think the reason why I'm telling you this is because what happened in the 70s and really why the gold price started to rise. And of course, there are other factors, but my sort of take on it is that, ultimately you deal with a crisis of confidence. And that is that investors lose faith in the government, lose faith in the policies of today, and then they look for an alternative. And really when people start to do that in a very meaningful way, that exacerbates the price movement, speculative aspects. And only in that kind of situation can you have a gold price that increases 8 times. So to go back to your point about right now, is it inflationary pressures that are driving commodity prices, or is it commodity prices that are driving the movement? I think that what we saw definitely in the late 70s was became a lot more speculative in the gold market, and that was I don't think gold could have risen to that height without the flow of investor money into the asset class at that time. But what's so interesting is, again, I think that we have some of the seeds of that sown today, where there is a crisis of confidence. Now, again, it's at the moment the central bank kind of front and center in terms of the policies, but also another number of other things related to COVID and all sorts of other situations that people be well aware of. But ultimately, I still think that gold is in a point where we're transitioning, just in that, like we were in the kind of early to mid 70s, where we're transitioning from an environment where people think that there's no sort of immediate need for gold, to an environment where once people start to, let's say, lose confidence in the monetary policies of today, or inflation just starts to get to a point where people feel like they need to act in order to preserve wealth, we're going to see much more or higher money flows in the asset class, and all things being equal, much higher prices.
And for investors who are interested in investing in gold, you have an ETF. The ticker symbol is BAR, very easy to remember, GraniteShares Gold Trust. It is one of the cheapest gold ETFs with an expense ratio of just 17 basis points, and it's a physically backed gold ETF. So definitely worth a look for investors who are interested in gold. Now, you also offer a platinum ETF, and platinum's price performance has really surprised me because we know about a decade or so back, platinum used to be called rich man's gold and most precious of the precious metals, and it always, commanded a price premium over gold. But platinum prices have been declining over the past few years, and now it is trading close to $970 an ounce. So tell us what is going on with platinum.
Yeah, you're right. So platinum, is 30 times rarer than gold in nature, and so it's a much smaller market, and therefore the relevance to the historical premium of the platinum price against the gold price was partly due to the fact that it was a much smaller market, and demand was such for platinum that it used to trade at a premium to gold, and that was sort of really so ingrained from a sort of market practice perspective that the word platinum became associated in the English language with the meaning above gold, and so hence the platinum credit cards and platinum status and things became something that was more prestigious than gold. But all of that has reversed, kind of quite spectacularly over the last few years, and platinum is really at a quite a significant discount to gold today. And like you say, sitting around $970 an ounce versus gold's $1,750 an ounce premium. And so that's kind of unprecedented, really, when we look at the history of these metals. And one of the reasons for it is that we're in an environment where demand for gold is high because we have ultra low interest rates, we have easy money. The things that people probably would associate with why demand for gold would be high at this particular level. But what's happened really with platinum is that the major demand source for platinum comes from the auto industry, where platinum's used in a catalyst that cleans the emissions on your vehicle, so in the catalytic converter. Now, in the case of platinum, it's particularly used for diesel-engined vehicles. And diesel-engine vehicles have really been in a decline from a market share perspective for a number of years now, but particularly since the VW or the Volkswagen kind of emissions scandal. And that really was a sort of trigger point that was one of the causes for governments to start and auto manufacturers to start sort of moving away from diesel in terms of passenger cars. And so from that perspective, add that into the perfect storm of COVID and all the problems with supply chains that everybody knows about, particularly in the auto industry. And you have the situation where platinum prices have been beaten down significantly because car sales haven't been there, but particularly for diesel cars in this environment. Now, on the one hand, I think that will improve, as supply chains resolve or start to resolve themselves a bit better. But platinum's fundamental problem at the moment is that the diesel engine market and its use as a catalyst is almost certainly going to dwindle over time. I think the bright spot for platinum is really that when we talk about future uses or technology-based metals, what's interesting about platinum is that it's used for as a catalyst for catalytic converters, but it also is used as a catalyst in the production of hydrogen for hydrogen fuel cell vehicles, which is obviously another technology that can produce electricity and therefore as an alternative to batteries. It can also be used for the production of green hydrogen, which is turning solar power, turning wind power, other renewable sources into hydrogen. And that hydrogen obviously then used to power vehicles. And I think what's interesting about that is that you need platinum obviously for both the production of green hydrogen and obviously for the hydrogen fuel cells. But particularly I think in applications outside of the passenger car, And although there's a market for hydrogen fuel cell vehicles today, and it will grow, and that will be an alternative technology to batteries, I think that some of the most interesting things are happening outside of passenger vehicles, so in heavy trucks, in airplanes or in aviation and shipping, where I think platinum could be a really interesting power source in the future, and maybe the dominant power source, green power source for some of these industries. And I think from that perspective, there's a really interesting story in the future, like platinum. And if hydrogen can do for platinum what batteries have done for lithium, then it could be a very interesting investment opportunity.
Definitely very interesting. And the ticker symbol of your ETF is PLTM. I also wanted to talk a little bit more about your broader commodity ETF, and you alluded to it earlier. The ticker symbol is COMB, and this is up about 23% year to date. Tell us what it currently invests in.
Yeah, so COMB or COMB is what we call a broad commodity strategy. So think of it as like a sort of an equivalent to something like the S&P 500, but for the commodity world. So it invests in actual commodity futures, so the commodities itself. It doesn't invest in commodity companies. And the way that the fund is structured, it invests on a diversified basis. So it replicates an index, which is called the Bloomberg Commodity Index. And in that particular index, the idea is that no one sector can represent more than a third of the index. So there are 23 commodities in the index. You have the four major sectors represented, which are precious metals, industrial metals, energy, and agriculture, which includes livestock. And when you blend those all together, you want to make sure that you don't have a skew to one particular sector. So with what you have with a lot of commodity funds, this is a weakness, in the sector, is a lot of commodity funds have a very high weighting to energy, for example. And what that means is you have very outsized volatility because the fund performance is very highly correlated to the oil price. Whereas with something like COMB or COMB, the idea is you have very disciplined diversification so that not one of those sectors is more than a third. And so what you get, therefore, is an index that's more diversified, and investors don't have to really take a bet on which way the oil price is going, like with a lot of funds. The other thing that's very important for investors is it's a no K1 strategy. So that means that when you buy the fund, you won't get a K1, although it's investing in underlying commodity futures. Now, that's just the way that we structure the fund at GraniteShares, but it's very important for people who either their advisors and they have clients who really get annoyed when they receive K1s around tax time, or it's just an extra thing that you don't need to be worrying about when it comes to filing your taxes. So that's an added benefit, as well as the very low expense ratio of 25 basis points.
Excellent. Now, switching gears a little bit, I wanted to talk about your best performing ETF, which is not a commodity ETF. It is the GraniteShares XOUT US large cap ETF. The ticker symbol is XOUT. And I looked at its performance since its inception in October of 2019. It is up more than 75%, handily beating the S&P 500 index, which has returned about 63% since then. Tell us a little bit about this ETF.
Yeah, so in our business, I mean, first and foremost, as you know, we're an ETF company, and so automatically, people think that means that we're purely involved in passive investing, and therefore passive investing to a lot of people means investing in the average of buying an index, holding an index, accepting that you can't beat the market, and therefore accepting the average of the good and bad companies in the market. Now, our approach is different to that in that we, from the indexing business and from the ETF business, we understand that traditional active management is very, very difficult to do. In other words, picking winners incredibly difficult to do over time, and that's why the majority of active managers can't outperform. But at the same time, just buying and holding the index, one of the inherent flaws of passive investing is that you have to buy the bad companies along with the good, for any given market index. And so the idea behind XOUT is to flip that paradigm on its head, and instead of focusing on picking winners, to focus on excluding losers, with the idea behind the research being that it's easier to identify a company that is at risk of underperforming or is in secular decline than it is to identify the next winner. So think about, what if, or it is the key to long-term performance, avoiding the Enrons in the portfolio versus trying to find the next Google. And I think that's really the philosophy that underpins XOUT. So we start with universe. It's a large cap strategy. So we start with the 500 largest companies by market cap in the United States. We score all those companies according to a 7 criteria fundamental model. And then we eliminate the 250 or half of them that have the lowest scores. And so what you end up with is a portfolio of 250 companies, market cap weighted, that's rebalanced every quarter, that we think is better positioned to outperform the market over time. And really, that's been the story of XOUT since inception, that the proof is in the pudding, and the model has been able to identify companies that have underperformed or risk of underperforming, and by leaving them out, has created that alpha, over the broad market, which is pretty impressive.
Definitely a very interesting approach. And that's all we have time for today. Will, thanks again for joining us.
Thank you so much. Great to be on the podcast again. Nice to talk to you, and hope to talk to you soon.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.